Hello everyone, and welcome to this session where we will discuss the double entry accounting system. Have you ever wondered how businesses keep their financial records accurate and reliable? This bookkeeping method is the backbone of financial reporting and is used by companies of all sizes across various industries. It ensures precision in record keeping and provides a clear picture of a company's financial health. Additionally, it aligns with the generally accepted accounting principles GAAP, making it a trusted framework for financial reporting. Let's dive in and see how it works. In accounting, we follow a standard rule called the double entry accounting system. This bookkeeping system records every financial transaction in at least two accounts, creating an inherent system of checks and balances. It enhances accuracy, minimizes the risk of fraud, and ensures reliable financial reporting. Additionally, it provides a comprehensive view of a company's finances, supporting better decision-making and more efficient resource allocation. To record these entries, we use two sides, the left side called a debit and the right side called a credit. When you enter an amount on the left side of an account, it's a debit, meaning the account is debited. On the other hand, when you enter an amount on the right side, it's a credit and the account is credited. To simplify this, we use abbreviations DR for debit and CR for credit. Whether you debit or credit depends on the type of account and whether it's increasing or decreasing. For assets and expenses, an increase is recorded as a debit and a decrease is recorded as a credit. For liabilities, owner's equity, and income, the rules are flipped. An increase is recorded as a credit and a decrease is recorded as a debit. Think of it like this. For each type of account, we ask ourselves two questions. Is this an asset, liability, equity, income, or expense? And is it going up or down? Once we know that, the rules are straightforward and consistent. To illustrate how the double entry system works in practice, let's consider the following scenario. Suppose you receive an invoice for $1,000 related to rent expenses. To record this transaction, you would create the following journal entries. Debit the rent expenses account for $1,000 because it represents an increase in expenses, which reduce equity and are recorded on the debit side, and credit the accounts payable account for $1,000 because it reflects an increase in liability, indicating that we owe $1,000 for rent. And here is a more intricate journal entry involving purchasing office equipment, supplies, and services. A company purchased office equipment for $450, office supplies for $700, and maintenance services for $850, totaling $2,000. The company paid 40% of the total amount in cash, with the remaining balance recorded on credit. How would these transactions be recorded? This transaction includes 3 debits and 2 credits. To ensure accuracy, let's verify that the total of the debit entries is equal to the total of the credit entries. The debits are $450 for office equipment, $700 for office supplies, and $850 for maintenance services, resulting in a total debit of $2,000. Let's analyze the cash payments before we start filling the credit side. The company paid 40% of the total amount in cash, which equals $800. The remaining 60% or $1,200 was recorded as a credit to accounts payable. As you can see, the sum of debits equals the sum of credits. Additionally, any change on one side of the equation is mirrored by an equivalent change on the other. Next, as discussed in Lesson 1, we'll revisit the transactions from Mr. Alan Bacon's law firm during the first month. This time, we will analyze them using T accounts to enhance your understanding and see the concepts in action. Get ready to connect the dots. Let's start by exploring the very first transaction that laid the groundwork for Mr. Alan Bacon's law firm. First, Mr. Bacon invested $5,000 in his law practice. The two accounts affected are cash and capital. To record this, we debit the cash account for $5,000 to show the increase in assets and credit the owner's capital account for $5,000 to reflect the increase in equity. Next, Mr. Bacon purchased supplies for $300 in cash. This transaction involves substituting one asset cash for another asset supplies. To record this, we debit the supplies account for $300 to reflect the increase in supplies and credit the cash account for $300 because we are paying out cash. In another transaction, Mr. Bacon purchased office equipment worth $2,500 on account from Altway Furniture Company. Since we are acquiring an asset, we debit the office equipment account for $2,500 to recognize this increase in assets, and because no cash is being paid at the time of purchase, a new liability is created. Therefore, we credit the accounts payable account for $2,500 to recognize this increase in liabilities. Later, Mr. Bacon earned $2,000 in fees. This transaction increases the cash account because we have received payment. To record this, we debit the cash account for $2,000 to reflect the increase in assets. At the same time, we also need to increase the owner's equity. Rather than crediting the capital account directly, it's more appropriate to temporarily segregate income from capital by using a dedicated revenue account. Therefore, we credit the fees income account for $2,000 to accurately reflect the increase in revenue. Next, Mr. Bacon paid $500 for office rent. Just as we separate revenue from capital, it's equally important to keep expenses distinct. For this purpose, we use a dedicated account rent expense to track these costs. To record this transaction, we debit the rent expense account for $500 to reflect the incurred expense and credit the cash account for $500 to account for the payment made. Following this, Mr. Bacon paid $200 for part-time help. To ensure proper tracking of this cost, we create a dedicated account called salary expense. Because separating expenses into specific accounts provides a clearer picture of the business's financial performance. For this transaction, we debit the salary expense account for $200 to reflect the incurred expense and credit the cash account for $200 to record the payment made. Mr. Bacon made a $1,000 payment to Altway Furniture Company to settle part of an outstanding account. This transaction reduces the company's liabilities because the payment fulfills a portion of the amount owed. To properly record this, we debit the accounts payable account for $1,000, reflecting the reduced liabilities. At the same time, we credit the cash for $1,000 to account for the decrease in assets resulting from this payment. At the end of the month, we conducted an inventory and found that $200 worth of supplies had been used. To accurately reflect this in our accounts, we need to make the following adjustments. We will reduce the supplies asset account by crediting it with $200. In turn, we will debit the supplies expense to account for the decrease in owner's equity. To break this down further, our supply inventory was valued at $300 at the beginning of the month. After accounting for the $100 worth of supplies remaining at the end of the month, we can clearly see the usage of $200. In this final transaction, Mr. Bagan withdraws $300 for personal use. But what happens when an owner takes money out of the business? Since this withdrawal is a personal transaction and not a business expense, it reduces the company's cash asset account. Consequently, the cash account is credited for $300 to reflect the decrease in available funds. As a result, owner withdrawals decrease equity. So we need a proper method to record this reduction without directly affecting the capital account. To do this, we open a drawing account and debit it for the same amount. The drawing account is a temporary contra-equity account enabling us to track withdrawals separately before they are eventually closed to the capital account. Before we conclude, let's quickly review the key takeaways from today's session. First and foremost, double entry accounting is the foundation of financial accuracy. Every transaction is recorded twice, once as a debit and once as a credit, ensuring that financial records remain reliable, precise, and balanced. Secondly, this system is not only for large corporations. It's widely used across various industries, from small businesses to multinational enterprises. Regardless of the size of an organization, double entry is crucial for maintaining proper financial management. Another significant advantage is that it enhances transparency and minimizes errors. By adhering to a structured system of debits and credits, businesses can reduce discrepancies, prevent fraud, and maintain a clear financial trail, making it easier to track and audit financial transactions. Lastly, double entry ensures compliance with GAAP or generally accepted accounting principles. This means that companies using this system align themselves with industry standards, making their financial reports more credible and comparable across different businesses. With that, we conclude our session on the double entry accounting system. I hope you found it insightful and enjoyed learning about this essential accounting principle. Thank you for your time, and I look forward to seeing you in the next session. Goodbye.